how big.
Good morning, guys. I am so excited to be back. Sorry about last week. I had something come up. We weren't able to be here. But this week, guys, we're here with Dan. Dan is actually a Stillwater native, and you guys might already know him. But of course, we're going to go over today's video. It's about variable cost versus fixed cost. But before we get into that, Dan, welcome yourself to the audience. Tell the audience a little bit about yourself.
Well, thank you for having me. I'm actually from Stillwater, graduated the last class at C.E. Donard High School, which is now Stillwater High School, which won the state championship in football, wrestling, bowling. I'm so excited about my pioneers, and also an Oklahoma State graduate, and I've been doing this for 30 years. So I'm excited to talk to you and your viewers about mortgages and what's going on right now.
That is so awesome. Wow. You've seen Stillwater change.
Oh, yeah. Drastically.
Well, every week as a real estate agent and as a lender, you come into hurdles that you're able to accomplish, and that's what makes you a successful lender. Was there a hurdle this week that you were able to help a borrower accomplish or come to light or realization about their qualification process?
Absolutely. The biggest hurdle, and this is why I tell people, you want to use a local lender that has local underwriters and that has great communications. We communicate every Tuesday to our borrowers, our listing agents, our buyers, and the title company. We call the title company, then the borrowers and listing agent, then update the borrowers. Why do we do that? Because things can change. Majority of the lenders right now do not put their files into underwriting until title and appraisal are received. And so 3 or 4 days before closing, they get a turndown. And, I had one customer that just happened to me at one of my live events, and they sat there and said, what do we do? And I talked to them, the customer, and there's no way to do it from day one.
Oh, man.
And,
wow.
But how I did turn it around is I said, but you can use the spouse and qualify on the spouse. And so I just said, drop them and use the spouse.
Yeah.
Now, the good news is we saved the deal. The bad news is they missed the closing because they found out 2 days before closing it was a turnout.
Oh, man.
Now, we will close it in 14 days. We have title work, appraisal, we have everything we need. We will knock it. And the only reason we can't close it earlier is because the CFPB says we have to have 10 business days after disclosure, or else we'd have closed it quicker.
Wow. So the wife was a really good borrower too then.
The wife was actually better and had a better score. And they got a better rate, a better score, a better loan, a lower mortgage insurance. But the other lender did not see that because they did not run their stuff to underwriting until a few days before closing.
That is so mind-blowing that a company would have a borrower spend money on inspections, spend money on appraisals, spend all that money, close to $1,000 sometimes up front, before they even check with the underwriter to see if it's going to be an actual loan that can be closed upon. That's mind-blowing.
Unfortunately, Josh, for a lot of your larger and especially a lot of your online lenders and some of your local big banks, that's how they do it. They just don't spend the money and let an underwriter look at the file until title, appraisal, income, all the documents are in it, and then they look at underwriting. We do it different here. As soon as we get a pre-approval, we already have the docs. So we get a contract. If we need anything updated, we update it. And then we typically in 5 to 7 days are out of underwriting. That's why we close so quick. We do not wait for title and appraisal.
No, because that's another hurdle you can cross later on.
Yep. Get the stuff out of the way. Get it out of the way. And that way, if you can cancel it, you cancel it before the appraisal's done and you refund the customer the money. They don't have the TRR might be done or might not be done. And I tell the agents that, you make that call.
Wow. Well, that's crazy. Today's video, Dan, I know you're busy. I know you got a lot of things going on. I don't want to keep you too long. Fixed rate versus variable rate. Both of them have their pros and cons, but a lot of people have stigmas against variable rate mortgages. What are some, do you want to start with variable? Do you want to start with fixed? I mean, everyone knows a lot about fixed. Which one would you want to start with?
Let's start with variable because the illusion of the variable rate is totally wrong, totally incorrect. So what I would tell people is historically, the variable rate is a better performing product. The variable rate historically has been a great option and a interest in when rates are going up, the variable rate is a great option. Okay. However, what most people don't understand is when to use it. Now, right now, would I do a variable rate? Absolutely not. I would not recommend anybody do a variable rate. Why? Interest rates, you said, Dan, you said when interest rates go up. Yes. But also, there's not a big bond market for Fannie, Freddie, and Ginnie to buy the variable rates. So there's not that big of a spread on the variable rate versus the fixed rate. And what a spread is let's say a customer right now gets 6%, or well, that's unrealistic. Let's say they get 7% on fixed. Well, right now they might only get 6.5 on a variable or
Oh
six and a
yeah.
quarter. And it could be a up to 5% increase on a 3 to 5 year arm. So in 3 years, you could go up 1% up to 5 years. So your 6.5 could be 11.5% in 8 years.
Wow.
Not a good option right now.
Not a
When
good
it is a
spread.
good option was if, let's say you were at 7 and the variable was 4.75, then you got 3 to 5 years of 4.75. Understanding you have to refinance it. See, most people understand if I have a customer, they got to have 2 qualifications. The first one is they have to qualify at the maximum payment. And so many lenders forget about that. I don't. And I tell people, look, your debt ratio is this at the variable rate, but at the max, which could be up to 11.5%, your debt ratio is out of line. Variable rate's not an option for you because you don't qualify for it. You have to qualify them at the highest. And the second thing, if the spread isn't good enough, I tell people, look, 2 to 3 years from now, everybody's probably even next year, everybody's going to refinance anyway. So if you refinance and you pay the extra fees and everything for variable, you just throw everything away. You don't do a variable unless you're going to keep it for the 3 to 5 or 7 year term. You then understand you do have to refinance it. Well, you don't have to. But now, who's it good for? If you have a first-time home buyer that's only going to be a house, I'll give you an example. Last one we did was a Boeing customer. He's only going to be here. He's on a 3-year contract. And this is before the rates went up. This was last year before the rates went up. And it was a 0.75 spread. So you got 0.75 as a reload. Boeing's paying for it all. He's got 3 years of a lower rate. He didn't care.
Yeah.
It was perfect for him. And he qualified at the higher rate. So variable rate is a good product for the right person.
And at the right time. That
And
spread
at the
sounds
right
really important because a lot of builders will give you a concession to buy down rates sometimes, and that would kind of match that spread.
Absolutely. The spread is just not right now. Fannie, Freddie, and Ginnie, the bond market liquidity is tight. The spread isn't that great to make it up. Now, if the spread gets 1%, 1.5%, oh my gosh, you'll see me how long. This is what I tell customers. First of all, what's your monthly payment? Where do you want to be? Second of all, how do you get my house? If they said first home buyers are usually only 3 to 5 years. I say, you sure? Let me introduce you to the variable rate.
Yeah.
But right now I don't do it because the spread, I don't even entertain it because the spread's just not worth the cost right now. Because I know that next year, after May 10th, my prediction is rates will start dropping drastically. No, I think we'll see the rates in the 5s by next year, but not right
Wow.
away.
Wow. 5 sounds good right now. So that's
Yeah, it
exciting.
does, doesn't it?
Well, that's some really great info on variable rates, Dan. Really appreciate that. Those were pros and cons all
Right.
mixed together. Pros of the fixed rate, and then I guess kind of differences too in 15-year payments to 30-year payments, because a lot of people don't think about the 15-year fixed rate mortgage.
Okay. I'm going to do an audible on you.
Okay.
The 15-year loan, you pay
Uh-huh.
more on your first payment on principal and interest. Did you hear what I just said? On your first payment, more money goes to principal than interest on a 15-year loan. The 15-year loan, the banks do not like because they don't make any money.
Yeah.
Because when you make your first payment, more money goes to principal and interest.
Yeah.
So a 15-year loan is a phenomenal product, especially right now when they made the tax changes and they increased the standard family deductions. In most cases, in fact, I'll give you a good example. I saw a mortgage loan officer post today about how mortgage interest is tax deductible and everything. And I'm going, really? Did they change the tax law since I slept? Because you got on a family of two or more, it's 24,000. Well, if you have
Right.
a $300,000 mortgage, you're not going to hit 24,000.
No.
So why would you post that? And I know her. I go, did they change the mortgage deductions? She goes, oh my gosh, you're right. I shouldn't have posted that. So she took it off real quick. So a 15-year loan is great. Who normally gets a 15-year-old? The 60s, 50, late 50s, 60, people close to retirement that don't want to have a house payment. They typically are the ones that ask for the 15-year loan. So now here's what the audible is. I did over half of my loans last year, 20-year loans.
Okay.
A 20-year loan on average per 100,000 can be anywhere from $90 to $120 more a month in payment. That's it.
That's not that much in today's inflation cost.
And here's what's beautiful about it. On a conventional loan, a 20-year, the mortgage insurance runs away and it's less in 4 years or 4.5 years, where it takes 11 years on a 30-year loan.
Wow.
I show everybody this chart and I tell them, don't believe me, Google it. I don't know, this millennial, got to see it. Google it. When do you think it takes, if you borrow $200,000 and you make every payment on time, Josh, when do you think your balance will be at $100,000 you pay down on a 30-year loan? How long do you think it takes?
18 years. 18 years.
23 years, 8
Dang.
months. On a 20-year loan, how long do you think it takes?
7.
11 years,
11.
4 months.
Okay.
Guys, the savings on average per 100,000 is $28,000 to $32,000 per 100,000 in interest savings. And if it's not a tax, and this is what I tell people, don't talk to me about it. Talk to your accountant.
Yeah.
You know what? Every time anybody ever does that and talks to their accountant, you know how the call goes? 20 years. You sure now? Because you get a lower rate, you get a lower mortgage insurance. And guess what? If you want to sell that house in 3 to 5 years, do you think you'll have more equity on a 30-year or on a 20-year?
20 all day long.
And people go, well, Dan, why don't other lenders do 30, do this? Because the most profitable loan for the bank is a 30-year. And the most profitable loan for a bank is a 30-year FHA, which I do very few of. I do them. People go, why do you do so few of them? It's the number one loan, 70% of them. I show people and I give them the comparisons. I give them an FHA, conventional, home possible, USDA, everything that you VA, what they qualify. And I've never had a case where a person that qualifies for other products, qualifies for other products, has ever taken the FHA loan.
The PMI never comes off on it, from my understanding.
It
so
doesn't.
You always have that bill,
right.
And then even though you have lower down payment over the long term, it's going to cost you a lot more for that extra 1.5 savings. Is that right?
Correct. But there's something that you missed that's critical that I show to people. On a FHA loan, how much is the down payment, Josh?
3.5.
No, it's not. Everybody's under the illusion it's 3.5. Do you realize you put 3.5% down and then the FHA loan adds a 1.75 funding fee, which takes half of your down payment away? And you're only putting 1.75 down. They apply 3.5 and then they add 1.75. So you're only getting credit for 1.75 of the down payment. That's why a lot of the bond programs and stuff, OFA and bond, when I introduce that to people, they go, wait a minute, let me get this right. OFA is going to give me 3.5% down, and they're going to put a silent second, and they're going to have some extra fees, and they're going to want that money back. And of that 3.5%, 1.75 is going to a funding fee, which is right into their pocket, plus their extra fees. So really, what am I netting out of this 3.5%? I said, really only about 1%. They're like, what? I show it to them in writing, and I said, Google it. A lot of people don't realize that 3.5%, you do put it down, but they immediately tack on a 1.75 funding fee to your file.
Wow, that's really interesting. And keeping towards the variable and the fixed cost information on today's video, This is all amazing information. Something that just came to me Is variable only a conventional product, or is variable also just the type of rate that you get? It works with FHA, it works with VA also.
Josh, that's a tricky question. It depends on your lender. It depends
Okay.
on what your lender does.
Yeah.
You know, we only offer variable unconventional right now,
Okay.
and we really don't push it because the bond spread is so, it's not, there's not a market. I've heard lenders that do variable and all sorts of products. So that's a tricky question. You need to ask your lender to see what they offer in that particular case.
Understood. 100%.
Yes.
What about when it comes to HELOCs? Do HELOCs offer variable? Is that not on the table for a HELOC?
All right. HELOCs are a great product. HELOCs are if somebody does a HELOC, like I, for example, we don't do HELOCs.
Okay.
If you do a HELOC, you go to your local bank.
Okay.
HELOCs are an incredible product if you understand them.
Mm-hmm.
Typically, they're 3, 5, 7, and most of them are 10-year fixed rates for 30 years, but they have a 10-year variable portion. And what you can do, just to make it simple, is you can lock, like I use my HELOC to buy rental houses.
Mm-hmm.
And so let's say it's like cash.
Yeah.
And I actually teach a class called Fire Me, and I teach people how to use HELOCs to buy houses cash, because that's what all the investors are doing anyway.
Yeah.
And the key is commercial money. So you get a $200,000 HELOC, you write a check. I go present some person, they want their house listed for 125. I have a certified check for 100,000. Actually just did one, 113,000. Say I can close in 2 days, but this is it. I can deposit the money right now in an escrow account and close in 2 weeks.
Yeah.
We didn't get the deal, but what the heck, I tried. But you have that beautiful. Now, let's say I did get it. Then I would take that HELOC, close on the loan. I would then lock that 113 in immediately, because on a variable, I want it on a variable, but I'd lock that in proportion. And then there's a lot more, but HELOCs are a beautiful thing. They're harder to qualify for, but if you're serious about investing, that's the way to go.
And speaking about investing, June is right around the corner. June is when they have all the real estate tax sales at the counties and stuff. Do you have any experience in those, just kind of off the cuff conversations?
Off the cuff, yes. Go to Texas. Go to Florida.
Okay. Okay.
Oklahoma's a tough market. Oklahoma's a tough market. It can be done. It's a different breed in Oklahoma. How they run those in Oklahoma, I do know some people that do okay in them. I'm sure there's some people do well. I don't know of any. Most of the people I do know that do that, they go to Texas or Florida, because it's a lot easier to get, and there's a lot more properties, and there's a bigger gap between the sales price and what they can do to resell the house.
Ah, okay, cool. Well, that's some really great info on fixed versus variable. We covered a lot of different uses on it.
Yep.
Are there any other final thoughts that the viewers need to know about when it comes to variable versus fixed?
Yeah, I would tell you right now, the biggest thing people know is, this is my opinion, what I'm about to tell you.
Right.
Buy now. Oklahoma is moving up like crazy. People are going to be coming here. Do I think rates will come down? My opinion, absolutely. Don't think until next year. But when the rates come down, and the market's not going to slow down. Oklahoma's being discovered, guys. You're going to have a competitive market when the rates come down, and then you're going to have a bidding war, and you're going to pay more for the house. So buy the house now, refinance in a year or two, but get the house now, because it's starting to swing more towards a buyer's market now. Take advantage of that. Don't let the rate bother you. You can always refinance.
And for those rate buyers who are waiting for interest to come down, renting is 100% interest.
Absolutely. I tell them, are you kidding me? You're going to wait? You might be waiting until next year. And then when you do, you're going to have an interesting surprise, because the market's going to get really tight in that $200,000 house. You might have to offer 220, 20 over to get it. We've experienced that.
Yeah, the median sales price for the Oklahoma City Metro is $202,000. I think it's affordable housing is becoming more and more difficult, even in the Oklahoma City Metro, to find.
Absolutely, and that's why you're seeing a lot of large builders coming into Oklahoma because they see that the builders in Oklahoma are building too many houses over 400,000.
Yeah.
So Lennar Builder, one of the largest in the nation, if they're coming to Oklahoma, and Yukon is one of the fastest growing cities in Edmond in the nation, that tells you something, because they're a low end builder, they're a cookie cutter builder, but they can build, and their target price is 175 to 225. That's what they're going to build, and they're going to make
Wow.
a gold mine in Oklahoma.
With your experience, how are those large builders like that going to be able to compete with land when we've already got people like D.R. Horton, Roush Coleman, Tabor Homes, Ideal Homes with a lot of land options? Do they go to those builders to try to buy out their options? In your experience?
In my experience, Lennar and these large builders are going to put some of these builders out of business.
Wow, that's crazy. That is crazy.
Absolutely, because they build so many houses. They build cookie cutter houses. They get a significant lower cost to build per square foot than the local builders. And the biggest reason I say that is a lot of the local builders have overbuilt 400,000 plus, and they overpaid for the land. Lennar knows that the land's going to come back. Lennar knows the land's going to get cheaper. I can't give you the name, but I know one builder that's selling every plot he can because they're hurting. And it's one of the ones you mentioned, but I won't tell you which one. So yeah, you're going to see a shift. Oklahoma's being discovered. And I'm excited for Oklahoma, because I think the next 3 to 5 years is going to be some of the best years for Oklahoma, because people are discovering it. And here's the key, the federal government has a lot of land through federal land grant, where they took the land for the turnpikes. It's called eminent domain. On June 20th of last year, we had a seminar at OAR with Senator James Lankford. He said Oklahoma is the #1 state for foreign investment. We are #1. People came in here and bought land like crazy from foreign. But the federal government has a lot of land that they're holding on to. And when it's right, they're going to have tax incentives. The federal government is probably sometime this year, where if you build a medium to low cost home, the government will give you a tax incentive on top of that. So Oklahoma is going to be in a situation where we are going to maintain our affordability, is my thought. I'm excited about Oklahoma's future, and the Pokes, baby. Go Pokes.
There you go.
Got some Pokes in.
Dan, do I've got your information correct down below?
Yeah, that's my office number, 437-4355. My best way to reach me is my cell, but that rolls to my cell, so that'll work just fine.
Okay, I'll get that updated in the future. Dan, this has been a great update. This has been a great pros and cons of variable versus fixed rate mortgage video. Thank you so much for your time. And if your schedule permits, next week, we'd love to have you back.
We're in. I've got to show my calendar.
All right.
This way. I don't know if am I in or not.
Yeah, you're in. You're in. Yeah.
Hey, you like the fish? All right.
Did you catch those?
Huh?
Did you catch those?
Yeah, we caught those in Hawaii. There's 3 of them. You can't see the little one, but we caught a tuna and 2 marlin.
Oh, you caught a tuna? Are you allowed to keep those?
Yeah, these are stuffed.
Okay.
So it's actually not the real fish, but what they do is they take pictures. These are all plastic, but those are actually the bills. The only thing real about it is the bills on all of them.
Okay. Okay. Well, what about the tuna meat? That stuff's really expensive. A tuna is.
Well, what we did is we donated all of our meat and stuff to a local charity.
Oh, wow. Wow. That's so amazing. Cool. Well, I know you got things to do. Thank you so much for your time, and we'll see you on the next one.
Bye.